Hello, my name is John Charbonneau, and I am an accredited mortgage professional. In the 15 years that I have been helping Canadian homeowners arrange mortgage financing, I have answered hundreds of different questions. This video reviews the top 10 questions that homeowners ask their lender about mortgage financing. Stay tuned, because at the end of this video, I will show you how to access a very special video entitled The Top 10 Questions Homeowners Should Be Asking Their Lender. Let's get started with our first question. What's the difference between term and amortization? Term refers to the period of time that you contract to have your mortgage with a specific lender. The term might be 1 year, 2 years, 3 years, or 4 years. And amortization refers to the pace at which you pay your mortgage off. You might lock in the interest rate for a 5-year term and be on a pace to pay your mortgage off over 25 years. The longer you amortize your mortgage, the lower your monthly payment and the higher the amount of interest you pay. The shorter you amortize your mortgage, the higher your monthly payment, but the less interest you pay. What is high-ratio insurance and when do I need it? In Canada, whenever a borrower has less than a 20% down payment, which requires them to borrow more than 80% of the property value, the mortgage is classified as high ratio. I like to say that that's a nice diplomatic term for saying high risk, and that's because the bank has lent you a lot more money than what you have personally invested in the property. A federal law requires the bank to go out and get an independent third-party insurance policy to protect them in case you don't make your mortgage payments. This insurance policy is called high-ratio insurance. In Canada, there are 3 independent insurance providers. The most common is Canada Mortgage and Housing, which is a Crown corporation. The good news about high-ratio insurance is that it's not like car insurance. You don't have to pay it year in and year out. It's a one-time only insurance premium that's added onto your mortgage and repaid to your lender. The cost of the insurance is on a floating scale, so the smaller your down payment, the higher the insurance premium. What's the difference between a regular mortgage payment and an accelerated mortgage payment? Well, let's say, for example, you negotiate a mortgage and you have an amortization period of 25 years and you make a regular mortgage payment. That means it's still going to take you 25 years to pay your mortgage off. With an accelerated payment, what the bank does is take your regular payment, usually a bi-weekly payment, and increase that bi-weekly payment. Over the course of 12 months, that little incremental increase to your bi-weekly payment works out such that you end up paying the lender 13 months worth of payments every 12 months. Because you're paying at an accelerated pace, you're going to pay your mortgage off faster. That typical 25-year amortization can be cut down to approximately 21.5 years simply by making an accelerated payment. The most common accelerated payment is a bi-weekly accelerated payment. If you had a $1,000 a month regular payment that would take you 25 years to pay your mortgage off, the accelerated bi-weekly payment would be $500. So over the course of 12 months, you're giving the bank the equivalent of 13 months worth of payments. You're accelerating the pace at which you're paying your mortgage off, and the faster you pay your mortgage off, the less interest you pay. Do I have to buy life insurance when I take out a mortgage? Well, the short answer is no. The longer answer is you should really consider the risk associated with having a big mortgage and something happening to you and you not being able to make the mortgage payments. This would be particularly important for someone that's married and has children. So it is advisable that you look at buying life insurance, but it's not required. Years ago, some financial institutions would offer you 2 different interest rates on your mortgage. One if you didn't buy their optional coverage and one if you did. But tide selling is against the law in Canada. A lender cannot require that you buy insurance when you take out a mortgage. You have to be very careful though. Some lenders have very crafty salespeople and they will give you a strong indication that you have to, but they won't necessarily say that in so many words. So you don't have to buy life insurance, but you really should look at your overall risk and determine if optional insurance is a requirement for your particular circumstances. Do I have to switch all of my banking to the lender that provides my mortgage? Once again, the answer in this case would be no. There are actually many lenders out there, referred to as monoline lenders, that don't offer any types of checking accounts or savings accounts, so you couldn't move your banking there anyway. Sometimes it happens to be more convenient to have your mortgage and your checking account and your savings account with the same lender. And in the old days, some lenders used to offer a lower interest rate if you brought over and maintained certain balances. By and large, though, you should look at not being required to do any additional banking with your mortgage lender other than having your mortgage with them. It might be a bonus to have your checking account with that same lender, but they can't require that. Oftentimes, you might have your mortgage with lender A and your checking account with lender B. Lender A will go into lender B's checking account by way of a pre-authorized payment and take out your mortgage payments. So don't worry, you don't have to switch your banking to the lender that offers you the best mortgage and interest rate unless you want to. Can I use my RSPs for some of the down payment? If you are a first-time home buyer, and that's someone that has not owned a home as their primary place of residence in the last 5 years, the answer would be yes. This is called the Canadian Home Buyers Plan. It's been in existence for over 15 years, and it's allowed thousands of Canadians to use the money in their RSP for a down payment and to pay the closing cost when purchasing a home. The wonderful benefits of this program are that when you take the money out of your RSP, you don't have to worry about any withholding tax, and there are no income tax ramifications unless you don't put the money back into the RSP. The repayment programs are quite generous. Your first repayment starts 2 years after you take the money out, and you have a full 15 years to put the money back into your RSP. The minimum repayment would be 1/15 of the amount that you took out. But if you come into extra cash and you want to put the money back into your RSP earlier than the 15-year pace, you're welcome to do so, and there's no penalty at all. The RSP Home Buyers Plan is a great way for people to get into the market using RSPs for the down payment. It must, however, be for your primary place of residence. You cannot use your RSPs for a down payment to buy a rental property. If I am pre-approved, can I make an offer without a subject to financing clause? Well, the financial institution doesn't require you to make an offer that is subject to financing, but with the smaller down payment you have, you need to know that any approval of financing is going to be subject to the lender looking at the property. So technically, any offer you make is subject to the lender approving your financing. However, one technique I've often found works very favorably is not to include that clause as long as you have what I call an out clause. You may leave out the subject to financing in your offer, but put in something like subject to home inspection. Work with your realtor because the subject to home inspection could be your out clause in the event that the lender doesn't like your property. So no, you don't have to put a subject to financing clause in the offer, but be aware that any final approval is subject to the lender approving the property. Can I include my property taxes with my mortgage payments? Pretty much all lenders in Canada will allow you to add on a small amount with your mortgage payment to go into a separate tax account so that the lender can pay your property taxes when due. Many lenders will require that you pay a little bit extra with your mortgage payment to go into a tax account, especially if you have a down payment that's less than 20%. Once you have at least 20% equity in your property, it's up to you. One of the things that makes it beneficial to work out a monthly payment plan with the municipality, as opposed to adding to your mortgage payment, is that some municipalities in Canada will pay you interest on the money that they're collecting from you. This is totally the opposite from banks who don't pay interest on that money that's sitting in a tax account. So have a look at how much your equity is, and if you have more than 20%, I strongly encourage you to set up a payment plan with your local municipality, not your lender. But again, if your down payment is less than 20%, many lenders require that you do add a little bit extra with your mortgage payment to go into a tax account. What documents do I need to arrange a pre-approved mortgage? There are two categories of documents involved, one to verify your income, one to verify your down payment. On the income side, if you're salaried, a letter of employment, a pay stub, and your last year's T4 slip would be satisfactory. If you work hourly, then what you would look at is a letter of employment from your employer stating the number of hours a week you work and what your hourly wage is. If you do a lot of overtime work, your employer should indicate that in the letter of employment. If you're self-employed, then you would want to provide the lender with 2 years worth of tax returns and your notice of assessment from Canada Revenue Agency confirming your taxes are paid and up to date. On the down payment side of things, you want to tell your lender where the money is coming from. If it's coming from your RSP, then generally your last RSP statement would be satisfactory. If the money's coming from checking and savings accounts, then you provide a 3-month history of your checking and savings accounts. If any of your down payment is coming from a gift or an inheritance, then ask your lender for a gift letter that documents you're receiving this money. It's a gift, you do not have to repay it, and it's for the purpose of owning and purchasing a home. What's the difference between being pre-qualified and being pre-approved? With a pre-qualification, it's a very short conversation with your lender. The lender asks how much money you make and how much you have for a down payment. They do a couple of quick calculations and say what you're pre-qualified to borrow. In the case of a pre-approved mortgage, the lender is going to be a lot more specific. They may even ask for documents to verify the income you state, and they'll dig a little bit deeper. They'll find out if you're self-employed. They'll find out if you're salaried. They'll find out if you have overtime or bonus income. And they'll also take a look at what your down payment is. Generally speaking, with a pre-approved mortgage, the lender has done a more thorough job than with a pre-qualification, and one of the benefits of being pre-approved is that the lender will lock in an interest rate for you. This allows you to shop knowing that you can pay a certain interest rate even though between when you get pre-approved and when you ultimately buy, if rates have gone up, you've got a cap on that interest rate, and that's generally for a 4-month period of time. So a pre-qualification is short and quick. A pre-approval is a little more involved and gives you a little better level of comfort knowing that you can shop with confidence, knowing that there's a very strong likelihood when you do find a property, the lender will ultimately approve you for what they talked about. What's the difference between an open mortgage and a closed mortgage? Within each category, you'll have 2 subcategories. You can have an open fixed rate mortgage and an open variable rate mortgage. With a closed mortgage, you can have a closed fixed rate and a closed variable rate. The word open means that you have unlimited prepayment options. You can walk into the bank and you can pay down as much as you want on your mortgage at any time without restriction. A closed mortgage, generally a lower interest rate than an open mortgage, will allow partial prepayments, a partial annual lump sum payment, the ability to increase your regular payments by a certain percentage, and possibly double up payments or up to double up payments. So open mortgages are great for people that have mortgages coming up for renewal and are planning on selling the property and don't want to lock into a long term in case the dates don't work out and they might incur a penalty. A closed mortgage generally, whether it's a fixed rate or a variable rate, will have a lower interest rate than a comparable term on an open mortgage, and that's for someone that's looking for a little more stability, and that's the difference between open and closed mortgages. Thank you for taking time to review the top 10 questions home buyers and owners ask their mortgage lender. At the beginning of this video, I offered you the opportunity to view a bonus video entitled The Top 10 Questions You Should Ask Your Mortgage Lender. To receive an email with the web address to find this secret cache of questions that many mortgage lenders don't want you to ask, simply send me an email at the address appearing at the end of this video. In addition, feel free to ask any questions you may have that were not reviewed here. Again, thanks for watching, and let me say that as your mortgage broker, my goal would be to educate you and motivate you to make intelligent mortgage choices.